As always, very interesting insights from David Roberts, and we now move to the other end of the risk spectrum. We are joined by Ian Clark from Veritas Asset Management to manage the Nedgroup Investments Global Equity Fund. Ian, as always, thanks so much for joining us this morning.
Thank you for having me.
I've had the privilege of going through your slides before today, so a lot of interesting topics we're going to touch on. But I think I'm going to hand over to you for the first handful of slides. Ian, I know you want to speak a little bit to performance, attribution, how any changes in the fund that happened in the last quarter, and then your positioning going forward and what the structure looks like. So I'll catch up with you in a handful of minutes when you're done with that section of today's session. Thank you, Ian.
Great. Well, thanks again for your time. The last 3 months of 2025 were a continuation of disappointing trends that we'd seen throughout the year, with the Ned Global Equity Fund returning 1.1% in US dollars versus a 3.1% return for the market in the quarter. 2025 was characterized by above-average gains across most equity indices, but several dynamics created a challenging backdrop for investors focused primarily on quality and with an absolute return mindset like ours. The best performing parts of the market were the biggest beneficiaries of current AI investment, most notably the semiconductor subsector, alongside typically low return and cyclical sectors such as banks and materials. Our process favors neither of these areas, and the types of high return on invested capital, resilient and cash flow generative businesses we prefer fell further out of favor during the year. As we enter 2026, we like our portfolio and the companies within it, and our forecasts suggest a forward double-digit prospective return versus a market that we think is becoming increasingly expensive and speculative. When we dig into attribution, again, the trends seen through the first 9 months of 2025 persisted in the last quarter, perhaps not surprising given the extreme returns to momentum that we saw during the year. Our significant aerospace position continues to perform very well as the recovery from COVID has evolved into excellent market conditions with large order books and strong demand. Charter was our most significant individual detractor in the quarter, underperforming as investors focused on broadband net subscriber numbers, which fell 109,000 in the quarter. We don't like to see declining subs either, but we note that this is a small loss in the context of the approximately 30 million homes that they serve. We continue to believe that over time, broadband subs will stabilize, and Charter today remains hugely free cash flow generative. All their other metrics were in line with expectations, and the valuation is exceptionally low. Healthcare and Diageo are both still at the bottom of unusual cycles experienced post-COVID, but in both instances, we expect them to return to healthy growth over the next couple of years and are quite excited by those positions. And we're particularly excited about the opportunity being created by poor sentiment towards software stocks and are using this to build positions in some excellent businesses, and I'll talk about that in a little bit. In terms of portfolio activity, the quarter saw us reduce our sizable Airbus position on strong performance, but then initiate a position in TransDigm, which has monopoly positions supplying parts and subsystems into many aerospace and defense end markets, so recreating some of that aerospace investment position that we'd reduced with Airbus. We continued to add to our software position by buying SAP, and we sold Charles Schwab, Hilton, and Siemens, which were all sold on good performance and full valuations. When we look at the portfolio as a whole, we haven't changed the shape in any major way. Today, we have about 15% of the portfolio in what I would call tech infrastructure, which are companies like Amazon, Microsoft, and Alphabet that have been performing well. We have about 12% in software, the likes of Salesforce and Dassault. We have about 20% in travel and transport, Airbus, Safran, Vancy, TransDigm. About 21% in healthcare, which would be United Health, Waters, Thermo Fisher. About 12% in consumer, which would be the likes of Unilever, Diageo, Hyatt, and Compass. And then about 14% in what I would loosely call financial infrastructure, so stock exchanges and derivatives exchanges like ICE and London Stock Exchange, MasterCard, which you'll all be familiar with, and then the insurance broker Aon. I can now move on to themes.
Thank you very much, Ian. A wonderful whirlwind there. Many people that have dialed in have been listening to your colleague Andy on our Perspectives Roadshow around the country, so I'm sure they got a good sense of what you've been chatting about there and a lot of colour behind everything you presented on. Your next slide here is who needs revenues anyway, and I have to admit this slide did make me chuckle somewhat. It reminded me of a series called Silicon Valley, and when they were looking to do some capital raising and visiting all the VCs and the private equity houses, they took out the slide showing their revenue, because the language was, if you're generating no revenue, they'll value you higher than what than if you were showing small to low revenue. So, I mean, this number is quite glaring, really. I think, if you look at the profitable NASDAQ versus the unprofitable small mid caps, NASDAQ no revenues, 85%. I mean, really a glaring snapshot of the market's speculative nature of it.
Well, I mean, I should say also that that's one of my favourite shows, and that scene is one that we occasionally send round. And I think that was back in kind of the 2020 teens, but at the end of 2021 we were sending that clip around about no revenue, and if you remember, that was a speculative top, and funnily enough, we were sending it around again over Christmas, and the point that we're really making here is just that the market, and I think it's obvious to everyone, is becoming increasingly speculative. And we can find plenty of evidence for this. But as you say, the chart on the left shows you that the best stocks you could have bought in 2025 had no revenue, let alone profit. And the further you were away from tech hype and speculation, essentially, the worse you were likely to perform. So the chart on the right demonstrates this, where it shows that the relative valuation of traditionally defensive sectors like staples and healthcare, and how the relative valuation versus the S&P has moved through time. These are typically boring in a sense, but typically high return and durable businesses, and they're about as far out of favor as they've ever been. And we can certainly see this in some of our healthcare and staples holdings, which are on surprisingly low valuations, in our opinion. We don't want to be exposed to hype, as we believe it's a good way to lose a lot of money. But as a result of that conservatism, our portfolio is suffering relatively as a result. Nevertheless, we believe that makes this a good time to pick up excellent, resilient businesses that are falling out of favor because they're not exciting enough. With that in mind, a good example of this and the opportunities that are being presented would be Compass Group, which we added in the second half of 2026. Compass, you may be familiar with, it's the largest contract caterer globally. It has particularly dominant share in the US, where it has 68% of its group sales. It's got purchasing scale advantages versus its competitors and local density, and other economies of scale that allow it to consistently take share while earning superior economics versus its competition. The contract catering market is very large and fragmented, and that means that Compass still has a very long runway for growth, particularly as they take share from in-house, inefficient operators that still represent about 40% of the market. Inflation is particularly good for this business because it makes the value for money of an on-premise canteen that doesn't need to pay rent particularly attractive and competitive versus other options on the high street, which means that these on-premise canteens are taking share because they're becoming more and more representing more and better value for money. And finally, the valuation here is compelling because this is a somewhat boring business and is being ignored today as a result. But also, there's a kind of some concern about the fact that white-collar customers will be impacted by AI, which we think is immaterial because office workers are only 20 to 25% of the business mix, and we think it's highly unlikely that has a real impact.
Wonderful, thanks very much, Ian. I do want to share the story because I wasn't that familiar with Compass Group, and I went and did a bit of digging into their founding. And when I saw that they were founded in 1941, I thought that coincides with World War II, and in fact it does. So the verbatim words here is that Jack Bateman established Factory Canteens Limited in response to the Factory Canteens Order, which mandated dining facilities for munitions factory workers during the war. This initiative aimed to boost worker morale and productivity by providing wholesome food, which laid the foundation for Compass Group's evolution into a major player in the food service industry. So quite a wonderful founding story behind the company there, which would have been, I guess, 85 years old this year.
That's right. And it's been brilliantly run, and particularly versus its competitors.
Well, such a wholesome founding story, I guess. That's hopefully it's shown those legs through the decades and continues to do so. The final portion of your presentation this morning is around AI and the software, and many viewers might be familiar with the AI kind of pyramid from the chips and the hardware that go into it, to the storage and the warehousing and the cloud computing, to the apps that we might see on our phone, to all the consulting industry that has started to really evolve around artificial intelligence. And this side speaks to what I particularly like on the right-hand side anyway is the narrative from Unilever, and you can see some skepticism initially moving to a bit of confidence to moving to almost like outright trust in what S&P were doing. But obviously you can speak a little bit more in detail on that.
Yeah. So you'll have heard us talk a bit about this previously, but the part of the market that I'm most excited about today is software, where I think we're seeing some of the best businesses that we look at get derated to pretty low multiples on the back of the concern that AI is making it easier to compete with them. And we think that there's an element of truth to this, insofar as it's undoubtedly the case that the cost of writing code is coming down, and we can see that it's falling quickly. But this is a misunderstanding of what the barrier to entry around the software businesses that we are interested in, what the barrier to entry is. The likes of Dassault, which we own, and Salesforce, they have systems of record on which their customers run their businesses. So these are deeply integrated into workflows, processes, business systems. They require high accuracy, security, compliance. Employees are trained on them, using them day in, day out. And their customers do not want to have to face the expense and upheaval of changing systems unless they absolutely have to. So this isn't about whether you can get a low-cost alternative. It's about these systems being deeply embedded into their customers. Therefore, when it comes to deploying AI, customers will look to their incumbent providers to support those capabilities within the existing systems because they don't want to switch. And in many instances, it's impossible to switch, which is one of the attractions of SAP. SAP, we bought towards the end of 2025 as it got caught up in the sector derating. SAP is the largest enterprise resource planning provider, and most of the world's largest businesses run on its systems. The switching costs are very high. It's almost unheard of that customers would change vendors. But for a number of years, there's been a debate going on as to whether these big customers would actually be willing to modernize their SAP systems, given the cost and hassle involved, or whether they just try to stay on their old versions. And this Unilever quote speaks to that. So we visited we visited all our portfolio companies, and we visited Unilever in 2022, and they talked about the fact it was impossible for them to switch off SAP. There was no way they were ever going away from SAP systems, but that they didn't intend to upgrade their system because they didn't see the point, and they didn't want to pay more for the new functionality that SAP were making available. So they were going to try to kind of minimize the expense while keeping the old system. And we've watched in the background as we've seen SAP continue to improve its new offering and continue to find ways to help customers move from old systems onto new systems. And we visited Unilever again in the autumn last year, and like you say, they've gone completely the other way. So they're now saying we absolutely are renovating our system. We're moving on to a modern SAP system because of all the functionality they've got, because we need it to deploy AI, and we're gonna have to spend more money on it because in order to get that functionality, it's gonna cost us money. And that's one anecdote, but we observe that happening across many, if not most, of SAP's large customers now, which is pretty exciting because that groundswell of activity to migrate onto new SAP systems that are more expensive is also happening at a time when we're getting some share price weakness, and so that's creating an opportunity. And I should say that this kind of anecdote, this way in which customers are having to kind of migrate onto new versions of their legacy systems in order to access our AIs is a journey we also expect to see Salesforce customers go on and Dassault customers go on. So we're pretty excited about this opportunity in software.
Wonderful, thanks, Ian. I guess a few things we hope hold true is that the white-collar workforce does continue to hold its position and not have the job losses that many do forecast. Yeah, in S&P, I mean, I remember first coming across a name as a youngster watching Ernie Els, a famous South African golfer with S&P plastered across his cap and wondering why he was sponsored by the South African Police Service. But clearly, I've learned a lot during that stage. And also the role of artificial intelligence in fund management as well. I think we appreciate how we can lean into it. But there is a human element which I think it can never replace or at least replicate in the skill around managing a fund, understanding markets, and making informed decisions. On that note, Ian, thank you very much for your time this morning. As always, take care and we'll catch up with you in about 3 months' time.
You too. See you soon. Thank you.